Hey everyone, welcome to the channel. Today, we're going to dive into a topic that could change your financial future forever: how to build and sustain your wealth. Now, I'm not just talking about making a quick buck. This is about creating long-term, sustainable wealth that will allow you to live comfortably and confidently for years to come. We'll cover some key strategies that wealthy people use to grow their money and keep it working for them. By the end of this video, you'll have a blueprint on how to not only build wealth, but also sustain it so it doesn't slip through your fingers. And trust me, there's one crucial strategy at the end that most people overlook. Stick around for that, you won't want to miss it. So, subscribe to the channel, and let's jump in. Why money isn't the goal. It's a tool. Let me start by sharing a story. A few years ago, my uncle was so focused on saving money that he missed the bigger picture. He had cut back on everything, barely spending on himself, and took pride in watching his savings account grow. But here's the thing. He was just hoarding money for the sake of it. He wasn't investing, wasn't enjoying life, and was so afraid of spending that it was almost like he didn't even have the money. That's when he had a realization. Money isn't the goal. It's a tool. It's meant to be used to improve your life, not to sit in a bank account gathering dust. Yes, it's important to save and invest wisely, but it's equally important to spend intentionally. Money should help you grow, not control you. It can create opportunities, reduce stress, and give you freedom, but only if you use it wisely. My uncle learned that building and sustaining wealth isn't about hoarding cash. It's about using money as a tool to grow more wealth and to enrich your life. You'll find that it's a balance between saving, spending, and investing that truly makes the difference. But here's the thing. Just understanding that money is a tool isn't enough. What's next? Let's talk about the foundation for building wealth: your job. Your job might just be the most powerful tool you have when it comes to building and sustaining your wealth. Too often, people think that the path to wealth means quitting their job and diving headfirst into risky investments. But let me tell you, your job is your foundation. It's the starting point for everything. When you think about it, your job is where your wealth-building journey begins. It's your primary source of income, and that income allows you to save, invest, and plan for the future. The trick is to use that steady income to fuel your financial goals. You can save a portion, invest another portion, and still have enough to enjoy life. That's the secret to sustainable wealth. It's about maximizing what you already have. But relying solely on your job is just the beginning. What if I told you that saving alone won't get you to financial freedom? It's true. Let's discuss why in the next section. Why saving alone won't get you to financial freedom. A lot of people think that simply saving money is the key to building and sustaining your wealth, like my uncle. While saving is important, it's not the whole picture. If you just stash your money away in a savings account, it's like watching it slowly lose value to inflation every year. Let me ask you, how many people do you know who became wealthy just by saving? Exactly. To truly grow your wealth, you need to invest that money. Investments allow your money to work for you. Whether it's stocks, bonds, real estate, or other assets, your money should be growing faster than inflation can erode its value. So, saving isn't enough. But what's the real key to wealth building? It's all about passive income. Let's explore how that works next. Now, this is where the magic happens. If you want to know how to build and sustain your wealth, you need to understand the power of passive income. Passive income is the money you earn without actively working for it, whether it's through dividends, rental income, or interest from bonds. It's the dream scenario. Your money is working for you even while you're asleep. What makes passive income so powerful is that it gives you financial security and freedom. Once you have enough passive income to cover your expenses, you no longer have to rely solely on your job to make ends meet. This opens up a world of possibilities. You could retire early, travel, or simply have more time to do the things you enjoy. One of the best ways to generate passive income is by investing smartly. Take dividend-paying stocks, for example. When you own shares in a company that pays dividends, you get a portion of their profits just for holding on to their stock. Over time, you can reinvest those dividends to buy more shares, creating a snowball effect. This compounding process helps grow your wealth exponentially over the years. But stocks aren't the only way to build passive income. Another powerful option is crowd-funded real estate. Crowdfunding has made real estate investing more accessible to everyday investors. Instead of needing hundreds of thousands of dollars to buy a rental property, you can invest a smaller amount into real estate projects alongside other investors. These crowd-funded platforms allow you to earn rental income or a share of the profits when the property is sold, all without the hassle of being a landlord. For instance, platforms like Fundrise or Realty Mogul let you invest in commercial or residential real estate projects with as little as a few $100s. You become part of a group of investors that collectively own a share of the property. And you earn passive income through rent payments or property appreciation. This can be a great way to diversify your income streams while taking advantage of the real estate market's growth potential. The beauty of crowd-funded real estate is that it allows you to benefit from real estate's long-term stability and income potential, even if you don't have the resources or time to manage properties yourself. Whether it's through dividends, rental income, or crowd-funded real estate, the key is to diversify your passive income streams. The more sources of passive income you have, the more financially secure and independent you'll become over time. If you want me to go in-depth about crowd-funded real estate and other types of real estate investing, let me know in the comments. Just type the word real estate, and I'll know you're interested in a dedicated video on the topic. But here's something to watch out for. Not every investment is truly an investment. Next, we'll look at the difference between investing and speculating. Let's make one thing clear. Investing and speculating are not the same thing. When you invest, you're buying assets that grow in value over time. Think long-term. Speculating, on the other hand, is more like gambling. You're hoping for a quick win by betting on short-term price movements, and it's risky business. For example, buying shares in a company that's been consistently profitable is investing. You're in it for the long haul. But buying a volatile cryptocurrency and hoping it doubles overnight? That's speculating. There's a time and place for speculation, but it should never be your main strategy for wealth building. Building and sustaining your wealth means taking calculated risks, but always with a plan in mind. Don't gamble with your future. Invest wisely. But even the best investments carry risks. Let me share a story about what happens when businesses fail to adapt. Let me share the story of Blockbuster. Remember the movie rental giant? In the 1990s, Blockbuster was the undisputed king of the video rental world. If you wanted to watch the latest movie, Blockbuster was the go-to place. By the late 90s, they had over 9,000 stores worldwide and seemed invincible. But as the entertainment industry shifted toward digital streaming, Blockbuster made a crucial mistake. They didn't adapt fast enough. Instead of embracing new technology and evolving with consumer demand, they stuck to their old model of physical rentals. Meanwhile, companies like Netflix saw where the future was headed and adapted quickly, first by offering DVDs by mail and then transitioning into streaming. Blockbuster, despite having multiple opportunities to invest in or buy Netflix, failed to take action. By the time they realized the shift in the industry, it was too late. In 2010, Blockbuster filed for bankruptcy, while Netflix thrived and became a multi-billion-dollar company. The lesson here is simple. Nothing lasts forever, and if you want to build and sustain your wealth, you have to be flexible and forward-thinking. Just like the entertainment industry, financial markets evolve, new technologies emerge, and industries rise and fall. Staying rigid in your investment approach can lead to missed opportunities or, worse, financial disaster. You need to be prepared for these shifts by keeping a diversified portfolio and staying informed about changes in the market. Whether it's through emerging technologies, geopolitical changes, or economic trends, market conditions can change in an instant. If you don't keep an eye on these shifts, your investments, like Blockbuster, could quickly become irrelevant. Flexibility, adaptability, and a long-term view are the keys to not just growing your wealth, but sustaining it in the face of inevitable changes. And speaking of protection, there's one key strategy that every investor needs to know about: diversification. Let's talk about that next. When it comes to building and sustaining your wealth, there's a golden rule: don't put all your eggs in one basket. If all your money is invested in a single stock, industry, or asset class, you're setting yourself up for a huge risk. What happens if that one investment tanks? You lose everything. Diversification is the key to protecting your wealth. By spreading your money across different types of investments, stocks, bonds, real estate, even commodities like gold, you reduce your risk. If one investment goes south, the others can help balance things out. It's like having a safety net for your portfolio. But even with diversification, there's another risk that's often overlooked: speculation. Let's break down why that's important. Let's be honest, speculation is exciting. The idea of making a huge return in a short amount of time is tempting, right? Who wouldn't want to double or triple their money overnight? But here's the reality: speculation is risky, and it's easy to lose money quickly if you're not careful. Speculating is like gambling. The highs can be thrilling, but the lows can be devastating. And the truth is, most people aren't as lucky as they hope to be. Even successful entrepreneurs like Elon Musk have lost billions by speculating on cryptocurrency. While Musk is a visionary who has built multiple billion-dollar companies, even he isn't immune to the volatility of speculative investments. This just shows that no one is above the inherent risks of speculation, no matter how much experience or capital they have. The lesson here is clear: if you're going to speculate, only do it with money you can afford to lose. Treat it like a high-stakes bet, something that won't hurt you financially if it goes wrong. For the majority of your portfolio, stick with investments that are grounded in long-term growth and stability. Think of solid, proven strategies like dividend-paying stocks, index funds, or bonds. Investments that may not have the flashy appeal of speculation, but will build your wealth consistently over time. It's important to remember that speculation should only be a small part of your investment strategy, never the foundation of your wealth-building plan. Now that we've tackled speculation, let's talk about one of the most powerful tools in wealth-building: compound interest. Albert Einstein once called compound interest the eighth wonder of the world, and he wasn't kidding. The power of compound interest lies in the fact that it allows your money to grow exponentially over time. When you reinvest your earnings, you're not just earning interest on your initial investment. You're earning interest on your interest. It's like a snowball effect for your wealth. For example, let's say you invest $10,000 at an 8% annual return. After the first year, you'll have $10,800. But the next year, you're earning interest not just on the original $10,000, but on the extra $800 as well. That's how wealth builds over time, slowly at first, but eventually it takes off like a rocket. When it comes to building and sustaining your wealth, time is your biggest ally. The earlier you start investing, the more you can take advantage of compound interest. So don't wait. Start now and let time work in your favor. But compound interest isn't the only tool you have in your wealth-building arsenal. Let's talk about how you can use debt wisely to grow your wealth. Are you ready? Here's something that might surprise you. Not all debt is bad. In fact, when used correctly, debt can be a powerful tool for building wealth. But here's the key. You have to know the difference between good debt and bad debt. Good debt is money you borrow to invest in assets that appreciate over time, like real estate or a business. For example, taking out a mortgage to buy a rental property that generates passive income is considered good debt. You're using borrowed money to create more wealth. On the other hand, bad debt is borrowing money to buy things that lose value, like a car or expensive gadgets. These purchases won't help you grow your wealth, they'll just drain it. To build and sustain your wealth, you need to use debt strategically. Leverage it for investments that will provide long-term returns and avoid debt for items that depreciate. This way, you can grow your wealth faster without putting yourself in financial jeopardy. And if you want to dive deeper into how to use debt wisely, we have several videos on this channel that explore different strategies in detail. Make sure to check those out if you're interested in mastering the art of good debt. But using debt wisely is only one part of the equation. The people you surround yourself with can also make a huge difference. You've probably heard the saying, "You are the average of the 5 people you spend the most time with." Well, this applies to your financial success too. If you want to know how to build and sustain your wealth, take a look at the people around you. Are they financially savvy, or are they living paycheck to paycheck? By surrounding yourself with people who are smart with their money, you'll naturally start adopting their habits, whether it's investing, saving, or managing risk. Being around financially successful people will motivate you to stay on track with your own financial goals. Of course, this doesn't mean you need to ditch your friends, but it does mean that you should seek out mentors or peers who can inspire you and help you make better financial decisions. Being part of a community that values financial growth will push you to continuously improve. But even with the right people around you, you still need a plan. Let's talk about why having an investment plan is critical to your wealth-building journey. Imagine setting sail across the ocean without a map. You might eventually reach your destination, but it's more likely you'll get lost along the way. The same goes for investing. Without a plan, you're just throwing money at random opportunities, hoping one of them will pay off. But hope isn't a strategy. Having an investment plan is like having a roadmap for your financial journey. It helps you define your goals, track your progress, and stay disciplined, even when the markets get rocky. Whether you're aiming to retire early, save for your kids' education, or just build a safety net for the future, an investment plan is the key to staying on course. Your plan should include a diversified portfolio, a strategy for reinvesting dividends, and a risk management approach that fits your financial goals and timeline. With a solid investment plan, you'll have a clear path to building and sustaining your wealth. But there's more to wealth building than just investing wisely. Let's discuss about how taxes can actually help you grow your wealth in the next section. Most people dread tax season, but what if I told you that taxes could actually be a secret weapon in your quest to build and sustain your wealth? Smart investors know how to use the tax code to their advantage, and it's easier than you might think. For example, investing in tax-deferred accounts, like a 401k or an IRA, allows your investments to grow without paying taxes on the gains until you withdraw the money later in life. This means more of your money stays invested, compounding over time. Another strategy is to invest in assets that generate passive income, such as dividends or rental income, which are often taxed at a lower rate than earned income. By understanding the tax benefits of different types of investments, you can keep more of your money working for you and less of it going to Uncle Sam. Now that we've covered taxes, there's one final piece of the puzzle to discuss: patience and perseverance. Let's wrap things up with this crucial mindset. If there's one thing that separates those who successfully build and sustain their wealth from those who don't, it's patience and perseverance. The truth is, Wealth building is a long game. It doesn't happen overnight and it's not always exciting. But if you stay the course, the rewards are worth it. Think of it like planting a tree. In the beginning, it doesn't look like much, but with time, care, and patience, that tree will grow strong and tall. The same goes for your investments. There will be ups and downs, but the key is to stick with your plan and keep moving forward. Remember, the people who build true wealth are the ones who stay disciplined, keep learning, and don't get discouraged by short-term setbacks. So, if you ever feel like giving up, just remember, slow and steady wins the race. And there you have it, how to build and sustain your wealth. We've covered everything from understanding that money is a tool, to using your job as a foundation, to the power of passive income and compound interest. We've also talked about using debt wisely, surrounding yourself with successful people, and the importance of having a solid investment plan. But remember, the journey to wealth is a long one, and the key to success is consistency and patience. Keep learning, keep investing, and most importantly, enjoy the process. Remember, the best investment you can make is in yourself. Whether it's expanding your financial knowledge, improving your skills, or working on your mindset, investing in yourself will always pay the highest dividends. As we conclude, it's important to note that this video is meant to educate you on the various aspects of investing, not to provide specific investment advice. Investing involves risks, and you should always do your own research and consult with professionals before making any financial decisions. Past performance doesn't guarantee future results, so always consider the risks involved. If you found this video helpful, I highly recommend checking out my next video, which complements this one perfectly. Don't hesitate to share this video, it might help someone else too. Please subscribe to the channel and share your thoughts on today's content. Thanks for watching. Until next time. Happy investing!